To better understand the Forex spread, and how it affects you, you must understand the general structure of any Forex trade. Hi, welcome to the channel. If you are new, please consider subscribing, so that you don't miss future videos. Remember to hit the like button just to motivate us to continue making these videos. By the way, if you are interested in making money online via trading etc., visit the links in the description box below. Let's get into today's video. One way of looking at the trade structure is that all trades are conducted through intermediaries who charge for their services. This charge, which is the trade's difference between the bidding and the asking price, is called the spread. What is the bid-ask spread? The Forex spread represents two prices, the buying, bid, price for a given currency pair, and the selling, ask, price. Traders pay a certain price to buy the currency, and have to sell it for less if they want to sell back it right away. For a simple analogy, consider that when you purchase a brand new car, you pay the market price for it. The minute you drive it off the lot, the car depreciates, and if you wanted to turn around and sell it right back to the dealer, you would have to take less money for it. Depreciation accounts for the difference in the car example, while the dealer's profit accounts for the difference in a Forex trade. Know that Forex market makers determine the spread. The Forex market differs from the New York Stock Exchange, where trading historically took place in a physical space. The Forex market has always been virtual and functions more like the over-the-counter market for smaller stocks, where trades are facilitated by specialists called market makers. The buyer may be in London, and the seller may be in Tokyo. An intermediary is needed to coordinate the transaction. The specialist, one of several who facilitates a particular currency trade, may even be in a third city. His responsibilities are to assure an orderly flow of buy and sell orders for those currencies, which involves finding a seller for every buyer and vice versa. In practice, the specialist's work involves some degree of risk. It can happen, for example, that they accept a bid or buy order at a given price, but before finding a seller, the currency's value increases. The specialist is still responsible for filling the accepted buy order, and may have to accept a higher sell order than the buy order they have committed to filling. As a result of accepting the risk and facilitating the trade, the market maker retains a part of every trade. The portion they keep is called the spread. As an illustration, every Forex trade involves two currencies called a currency pair. This example uses the British pound, GBP, and the US dollar, USD, or the pound sterling to US dollar currency pair. Suppose that, at a given time, the GBP is worth 1.1532 times the USD. You may believe the GBP will rise against the dollar, so you buy the pound sterling to US dollar pair at the asking price. The asking price for the currency pair won't exactly be 1.1532. It will be a little more, perhaps 1.1534, which is the price you will pay for the trade. Meanwhile, the seller on the other side of the trade won't receive the full 1.1532 either. They will get a little less, perhaps 1.530. The difference between the bid and ask prices in this instance, 0.0004, is the spread. Using this example, the spread of 0.0004 British pound, GBP, doesn't sound like much, but even a tiny spread quickly adds up as a trade gets larger. Currency trades in Forex typically involve larger amounts of money. As a retail trader, you may be trading only one 10,000 unit lot of pound sterling to US dollar. But the average trade is much larger, around 1 million units of pound sterling to US dollar. The 0.0004 spread in this larger trade is 400 pounds sterling, which is a much more significant commission. So how do you manage and minimize the spread charged by the broker? You have two ways of minimizing the cost of these spreads. First is trade only during the most favorable trading hours, when many buyers and sellers are in the market. As the number of buyers and sellers for a given currency pair increases, competition and demand for the business increase, and market makers often narrow their spreads to capture it. Second is avoid buying or selling thinly traded currencies. Multiple market makers compete for business when you trade popular currencies, such as the pound sterling to US dollar pair. If you trade a thinly traded currency pair, there may be only a few market makers to accept the trade. Reflecting on the lessened competition, they will maintain a wider spread. What's a good spread in Forex? You can watch the most liquid Forex pairings to get a sense of what a good spread is in Forex. US dollar to Japanese yen and US dollar to pound sterling are popular Forex pairs. You might compare those pairing spreads to other pairings. It might also help to compare the spreads between brokerages to ensure you're getting the best deal. What does a high spread mean in Forex? High spread suggests that a pairing is less liquid than other pairs. In other words, fewer traders and fewer dollars are focusing on the pair. The fewer traders focusing on a pair, the less likely it is that someone is willing to offer a price that's closer to the opposing side of the trade. When trading happens less frequently, the spread increases. Brokerages may also include trading fees in the spread, even if it markets itself as a commission-free trading platform. If you learned something new in today's video, please remember to click the like button. Leave a comment with your thoughts in the comment section below. Again, hit the subscribe button so that you do not miss future videos. We will see you in the next video.